This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
MacroVoices episode 454 was produced on November 14th, 2024. I'm Eric Townsend. StoneX chief macro strategist Vincent Deluard returns as this week's feature interview guest. We'll discuss secular inflation, the gig economy, and what Vincent is calling the shadow lending and savings markets. Vincent's take on precious metals in the wake of the election and how far they have left to fall, plus a new hypothesis Vincent is calling the five-body problem. After the feature interview, in our postgame segment, I'll add some of my own commentary about the news flow coming out of the Trump transition team in the wake of the election, including what Elon, Vivek, and Tulsi's appointments will mean to establishment wings of both political parties.
And I'm Patrick Ceresna with the Macro Scoreboard week over week as of the close of Wednesday, November 13th, 2024. The December S&P 500 futures up 97 basis points, trading at 6,016. The post-election momentum continues. We'll take a closer look at that chart and the key technical levels to watch in the post-game segment. The U.S. dollar index up 130 basis points, trading at 106.48, ripping into resistance at multi-year high. But will we see the breakout? The December WTI crude oil contract down 455 basis points, trading at 68.43, continues to trade along support lines established over the last few months. The December RBOB gasoline down 396 basis points, trading at 194. The December gold contract down 460 basis points, trading at 25.53, quickly retracing 50% of the gains made since the summer. Copper down 565 basis points, trading at 401. Accelerated selling has us back down to the August lows. Uranium up 149 basis points, trading at 78.30. The U.S. 10-year Treasury yield up 2 basis points, trading at 4.45. The key news to watch this week is Friday's retail sales number. And next week, we have the European and U.S. flash manufacturing and services PMIs. This week's feature interview guest is StoneX chief macro strategist Vincent Deluard. Eric and Vincent discuss secular inflation, impact of Trump's policies, the shadow economy, and more. Eric's interview with Vincent Deluard is coming up as MacroVoices continues right here at macrovoices.com.
And now, with this week's special guest, here's your host, Eric Townsend.
Joining me now is Vincent Deluard, who heads up macro strategy for StoneX. Vincent, I can't believe it's been 4 years since we had you on the show. It's great to have you back. Listeners, Vincent has shared with us some really excellent research. It's the stuff you normally have to pay for. It's linked in your research roundup email. We're going to talk about 3 separate StoneX intelligence reports. Vincent, let's just start with the big picture of you made the call, as did several of our other favorite guests. Our mutual friend Louis Gav called the secular inflation several years ago, as you did. Everybody else was saying, it's transitory, it's just going to be short-term pandemic effects. You were the guy to say, no, the pandemic is the catalyst that's going to bring about a secular inflation. Seems like you and Louis and a number of other smart people are being proven right. Let's just get the big picture update. What's happening with inflation? Or do you still have that view that this is the beginning of a secular inflation? Because look, we're just having what seems like the end of a wave. A lot of people are saying it's ending.
Yes. Thank you. It's a pleasure to be back here, and thank you for the introduction. The secular call would not be a secular call if we were to change it just because one measure of inflation, and I'll stress that the CPI is a measure of inflation with certain biases, certain choices, but it's not inflation itself, has come down to levels that are still far above what we had before. So yes, inflation is a process, not an event. And it typically occurs in waves. So seeing some cyclicality in inflation, like that little sine pattern that we are seeing, is actually what you would expect. And that's what you see in the past. If you think about the 70s, you had these three ascending waves, right? 1971, 1973, 1979. If you think about the 50s, you had one when the US mobilized, another one during the war, and then another one after the Korean War. I've actually went all the way back using Bank of England data back to the Middle Ages to test this hypothesis that inflation indeed is a wave-like pattern. So the notion that we'd have a kind of one and done is very, I wouldn't say unprecedented because I haven't data on all countries. I could say it would be certainly the minority to see a single wave and then we just go back to the old world. One thing I wanted to rebound upon is also when you mentioned COVID was a trigger. I think that's factually correct. But I think it's the response from COVID that was the trigger. COVID itself was neither inflationary nor deflationary. I mean, events are somewhat neutral. You could have made a case that COVID was going to be deflationary, right? If we had not responded to it, if we just had basically, dramatically cut our consumption of commodities, oil prices went negative, it could have been deflationary. And actually it was in China when we had a completely different response. COVID was a deflationary shock. What was inflationary after COVID was the response, the fact that we blew up the deficit. I mean, the deficit increased more than it did during World War II after COVID. And contrary to World War II, it did not normalize after that. This is the part that's inflationary. This is the policy function, the reaction from the Fed, from the fiscal authorities. This is what creates inflation. And this is what makes me think that it's going to come back. Not because of some external shock. I obviously cannot predict shock. In 1979, it was the Iranian Revolution that triggered it. 1973 was the OPEC oil embargo. There is going to be another shock. And the response to that shock will be inflationary.
Let's talk about what this means in the context of President-elect Donald Trump's coming into office. Clearly, he has some intentions to shake some things up, change some policies. Are those going to exacerbate this inflation that you're anticipating, or are they going to maybe make it a little bit better?
I would think so. At the core, Trump is a populist candidate. And I don't mean that in a derogatory way. I believe democracy should be run for the benefit of the people. So populism is not a dirty word. But populism is essentially inflationary. We also have the experience of the 4 years of the first Trump mandate, where he inherited an economy that was really on the verge of deflation. I mean, remember back in 2015, 2016, we had the Chinese devaluation. We had a massive slowdown in GDP growth. We were below the target. We had very weak commodity prices. And then when Trump came in, kind of kicked in all the animal spirits, inflation came up. So I think this time it's going to be even stronger because he has an even greater popular mandate, all three branches of government. He also has a popular vote. He also has, I think, his game better together. I mean, one of the things that was unsettling about Trump 1 was the massive turnover in the administration, the lack of clarity between various parts of his administration who seem to be fighting each other. I suspect some of that is going to be a lot more consistent this time, with probably a much bigger role from that populist faction that really put him through the line. I mean, if you look at the poll, I think probably RFK did a lot for Trump. I mean, Tulsi, J.D. Vance, that kind of populist, isolationist, America first line is probably much stronger. There will be a lot less resistance also among traditional Republicans because a lot of them have been voted out. Basically, if you did not kiss the ring, you were kicked out. So greater leeway for him to implement his agenda. And then finally, also very different economic conditions. As I mentioned, when Trump was first elected, the economy was on the verge of deflation. We're still in the mid 2010s, which was a deflationary decade. We had quite a bit of austerity under Obama. We had zero rate. So the Trump policy shock was actually positive. This is what the economy needed. The economy needed fiscal stimulus. The economy could handle tariffs because really what happened is the dollar went up. So effectively we didn't repay for the tariffs. So the policy prescription of Trump 1 economically were correct. In 2024, we have a very different situation. We have an economy that's growing at 3% for 8 quarters. We have inflation that is, I think I would call that almost an optical illusion, the fall to 2.4%. I mean, we can talk about it later, but I I mean, if you go down, I don't think inflation has fallen to 2.4. I think I would look at things like core services, ex housing, that shows that it's around 4.5%. So we're already twice the target. We have no output gap, and we also have immigration. We have ex-immigration, what I think is a very tight labor market. So again, very different circumstances, which will likely mean that you start from a base that's a lot more inflationary and you add fuel to the fire.
Vincent, back in the day, this was a pretty easy investment call. You think there's secular inflation, you buy gold for your portfolio. It seems like maybe the rules are changing, because in minutes after the Trump win was clear, the gold market started crashing. We're down $250 already on gold. And this is happening really when most people had predicted that a Trump win would be extremely bullish for gold. I think what's going on here is a rotation out of gold into Bitcoin because of President Trump's seemingly strong desire to accommodate the crypto community. Is that what this is? Is it something else? Why is gold going the opposite direction from what so many people predicted?
I think you're spot on. The rotation into crypto, I mean, you can see it, basically one goes straight up, the other one goes straight down. I want to maybe contextualize the falling gold prices. I mean, we're still at 2,600, I mean, come on. In a way, it's healthy. Like that, you don't want a market that goes straight up, because these blow off top, that mean you can't go on forever. So some consolidation. And even if we go down to 2,400, that's really not the end of the year. I mean, gold had a fantastic year. So, it's not a bad thing for us to digest these gains. The other, idea is very much linked with what you said about the election, is gold's value as a hedge against political uncertainty. Going into the election, if you read the polls, it was basically tied, right? I mean, and of course it was manipulated, right? The pollsters were all hurting and nobody wanted to have their neck stick out. And so it was fake. But nonetheless, there was a narrative that we're going to have this late election, and that maybe by the end of Tuesday night, we wouldn't know who win. Both candidates would claim victory, would have some sort of January 6th-like event. And I think some of the trade was, okay, buy gold in the event that we see true political instability in the US. You saw that also in the skew. Puts were a lot more expensive than calls. The VIX was very elevated. So the unwinding on that trade really is kind of bringing the VIX down to lower level, taking down away with it. And then Bitcoin's kind of acting the other way, because we have all these enthusiasm about, Trump being the first crypto president and so forth. But again, this is a trade. It's going to wind down. Eventually, it's going to run out of sellers. And then we'll go back to what I think are the fundamentals of the gold trade, which is a big accumulation by central banks, secular inflation, and a Fed that is consistently and on purpose, by design, behind the curve of inflation, i.e. maintaining negative real rates, which is, of course, very bullish for gold.
I couldn't agree with you more on all of those points, but now I get to do the fun part and put you on the spot. As we're recording Tuesday afternoon, we're just barely holding on to the round number at 2,600 after a few days of really aggressive selling. Is it ending, or is it just getting started? Is this the time to buy the dip, or should we be hedging our gold positions and expecting more turbulence before it's eventually time to buy it much lower?
I'm not the best short-term trader, because it's a great way to look like a fool. But if I were to make a guess, I think we're closer to the bottom than we are at the top. And if your horizon is anywhere longer than 5 months, I think this is a buy the dip opportunity. One way, this could resolve, is, I mean, we still have a lot of potentially gold bullish development ahead of us. I mean, I keep looking at a dollar index chart and seeing this dollar shooting straight up. At some point, that's going to be a problem for Donald Trump. If we really want to do reindustrialization, bring back to Ohio, Appalachia, we can't do that with a $110 index. So at some point, we're going to see Trump really balking at higher rates, trying to get other currencies to be revalued. And once you start to see the dollar index, maybe not fall, but at least stabilize, that gold is going to shoot straight up again.
Vincent, maybe you can help educate me because I think President Trump must understand some aspects or nuances of macroeconomics that I haven't learned yet. One of his statements is that we absolutely positively must defend the U.S. dollar's role as global reserve currency because the U.S. gains a lot of strategic benefit from that effective monopoly over its dominance of the global monetary system. We can't let go of that. He's been very emphatic on that point. Then a few minutes later, he talks about a strategic Bitcoin reserve. Now, Bitcoin is a currency system that was designed for the express purpose of undermining the monopoly that governments have over the money system, decentralizing money so that no government is in charge of it, and so that the concept of a global reserve currency is effectively replaced by a new paradigm. Vincent, does President Trump understand something I'm not giving him credit for, or is he making inherently contradictory statements evidencing that he's the one who doesn't get it?
I think he's just being a politician here. I mean, obviously he got the endorsement of the crypto Bitcoin community. He wants to throw something back at them. I'd be very surprised if we saw this Bitcoin national fund. By the way, we kind of already have one, right? Because every time the FBI sees these crypto assets relative to criminal activity, it actually, my understanding is it ends up on the account of the U.S. government. So we already have a Bitcoin fund. So I wouldn't put too much credence into the idea that we're going to create a Bitcoin sovereign fund, or also the idea that we're going to have a sovereign wealth fund. These are all things that, Trump likes to float around. But again, we had 4 years of Trump. That did not happen before. It's very hard to see a strong policy case for it.
So fade the strategic Bitcoin reserve, but considering what we've seen in the market, clearly there's a rotation going on. Should those of us who have been skeptical of Bitcoin specifically because, what I've always said is, look, the idea of democratizing the money system so the people own it instead of the government's owning it, I love the idea. I just thought it was impossible that government would ever allow the loss of its monopoly and that they would fight it. It seems like President Trump doesn't want to fight the faction of the Bitcoin community that would like to promote Bitcoin as more of a trade settlement and maybe even reserve asset currency for other central banks. Does that maybe change the thesis and say that people should be allocating more into crypto or beginning to allocate into crypto if they had previously seen gold as the right trade there?
Again, on that, I would follow the action of central banks rather than the words. Words are cheap. If you see what central banks are doing in Russia, in China, in Turkey, in Kazakhstan, and in India, you see this very clear move towards gold. Or maybe, I put the BRICS currency idea in the same category of ideas that keep coming back and never actually happen. But I don't really see a huge impulse from central banks to load up on Bitcoin because that's the next asset and that's the easiest way to transact rapidly. It's not. So this might be one of these cases of sell the news, like buy the rumor, sell the news. So the run up to the Trump election was very good for Bitcoin. I suspect that the second part of it, now that we had all the possible good news, we had the Bitcoin ETF, we had we're going to fight Gensler. What's the next, now that you even have boomers that are buying Bitcoin on, regular exchange on 401ks. Where is the next wave of money going to come from?
Vincent, before we leave the inflation topic, I just want to let our listeners know that you penned an excellent piece back in August titled "Inflation is a Process, Not an Event." Listeners, you'll find that linked in your Research Roundup email. Vincent, let's move on to another piece that you wrote called Shadow Work, Shadow Lending, and Shadow Savings. What's that one about?
Well, it's about something that's been puzzling, I think, economists for a long time. It's a diffuse sense that the tools that we have do not seem to capture reality as well as they used to. And you can see that in pretty much any official statistics that you see, whether it's the discrepancy between income and GDP, whether it's revisions to the non-farm payroll numbers, whether it's revision to the GDP estimate, or whether it's the savings rate. There seems to be something about this economy that we can't quite measure. And that something seems to be on the positive side. Right? Growth has been, generally speaking, much more resilient than people thought. Consumption keeps surprising to the upside. So there seems to be this kind of shadow economy that we're not quite getting. And I was making an hypothesis, which I've made for a long time, that I'm going to start with the shadow work, but then I'll go into the shadow savings and then the shadow lending. So shadow work, I think, is the most important part, which is that basically the US is going backwards in terms of development. The idea when you study development economics is you have this kind of shadow economy where people just use cash and sell stuff on the street. And then as development happens, more people work for big companies, and then everything gets taxed for the banking system and all that. My impression is that the US is going the way of Brazil or Colombia or Peru, where the part that you see actually shrinks and the part that's on the shadow is exploding. And part of it is technology, right? If you think about the past 20 years, all the major innovations that we had was what I call reinventing the coolie, basically finding ways to utilize assets or workers in a flexible way that is not for their primary job. So, you have an in-law unit. Well, put it on Airbnb, get some money back with that. Or your car is sitting around. Well, just rent it to lease it to someone else, and that someone is going to drive Uber or DoorDash. Or, if I ask my 9-year-old kid right now what he wants to do when he grows up, he's going to tell me he wants to be a YouTube creator. If he were a pretty girl, he would probably another format that I'm not sure I'm allowed to discuss here, but I will just mention that OnlyFans creator last year made more money than the entire NBA altogether. So we had this explosion of gig avenues for people to earn revenue outside of their main job. That was going on before COVID, and then COVID accelerated that because suddenly most people were working from home and a lot of them stayed from home, which made this even easier and easier. So no one really knows how big that is. The one way I can track it is by looking at self-employment tax collection. So this is tax that's collected on income that's coming from self-employment, not the part that's withheld from your W-2, your paycheck. And the growth here is just stunning. We've come from almost nothing, to $1 trillion in tax receipts. So let's say you have $1 trillion in tax receipt, right? This is what you tax. So the base, let's assume that the tax rate is 20%, which by the way is too high. I mean, probably 15% would be better, but let's go with 20%. That means that the underlying stream of income that you're taxing is 6 trillion. I mean, 6 trillion is 20% of US GDP. 6 trillion is about twice the size of Brazil. So what I like to say is that there is a Brazil, two Brazils that are hiding in the US economy and growing by 10% or more a year. And that's been going on for 6-7 years. So to me, this is really the engine that explains a lot of resilience of consumption, because maybe people are losing their job, but 15 years ago, when we had the great financial crisis, if you lost your job at a car factory in Detroit, that was it. You were done for. You started to default on the credit card, default on the home. You didn't have that many options because no one else around you was hiring. Today, you lose your job, you can sign up as an Uber driver. I mean, according to Uber CFO, the Uber drivers make an average of $35 an hour. Now, that doesn't include the cost of gas, the cost of insurance, the cost of the car, but these are expenses that people have anyway, right? So the ability to get that new job means that this halo of employment, the distinction, when we do the household survey, people ask you, are you working or are you not? And that's how we divide the unemployment rate, which is a horrible way to do it, by the way, but never mind. It's not that clear anymore. People are always kind of working and they're always kind of not working. So that creates this dynamism, and that creates also these big discrepancies between various measures of the unemployment rate. So that's the shadow work part. The shadow lending comes from the fact that for 15 years now, we've been hammering banks with regulation and restrictions on the lending they can do. And of course, nature abhors a vacuum. So someone stepped into that, and that was private debt and private credit. Now, if you look at the whole private debt market, it's now bigger than the junk bond market. So we've added about $2 trillion of credit to the economy that doesn't show in the books of the bank. So that's why you can see like a senior loan officer survey that tell you we're tightening lending standards. And then you see what everyone around us sees, which is this massive boom. Like there's no financing problem in the US. Financial conditions are easy, but it's not coming from the banks. And then the last part is what I call shadow savings. So again, here we had these completely erroneous papers that the Fed published a couple of years back saying excess savings have been depleted. They're not depleted. They're still in the system. But more important than the excess savings is the wealth effect. If you look at household net worth, so you take a household sector, assets minus the liabilities, it increased by 44 trillion since COVID. Actually, probably now we're at 50 with the Trump shock. So let's say 50 trillion. Now, the savings rate, the national savings in a year, we save $1 trillion. So that 50 trillion increase in net worth is 50 years of savings that we've added to people's balance sheet. So of course that's going to have an effect. And you add all these three and that creates this economy that just won't slow.
Vincent, off the air, you used the expression recessions have been canceled, or a thesis that you have that recessions have been canceled. How does this all fit into that, and what does that mean exactly, that recessions have been canceled?
Well, let me start maybe with the framework. So I like to use the quadrant framework, which a lot of other shops use, GAFCAL, HedgeEye. On your x-axis is inflation, on your y-axis is growth. And you basically have 4 economic quadrants you can be in. Strong growth, strong inflation is the inflationary boom. Strong growth, weak inflation is a disinflationary boom. Strong inflation, no growth is stagflation. And then no deflation plus recession is a deflationary bust. My impression is that with policy, we can always cancel one of these quadrants. We cannot pick which one we're going to be because we don't really have, we don't really control growth, but we can avoid an outcome. And based on the experience of the past, policymakers will be biased towards avoiding a certain outcome. For example, after the Great Depression, there was this kind of Keynesian moment in the US, like, okay, we cannot allow that to happen. We cannot have a deflationary bust. We've seen what happened with the Great Depression and then World War II. So after that, after World War II, we had about a 34-year period during which the mix was somewhat inflationary. We were basically avoiding that deflationary bust quadrant. And then after the great inflation of the 70s, we had the exact opposite memories. You saw what happened with Jimmy Carter, the malaise in America. And they okay, oh no, we cannot have stagflation. And all of policy was now designed to avoid that quadrant. My impression is that after the 2010s, which was basically an era of deflationary bust globally, of excessive fiscal restraint, ineffective monetary policy making has changed, and now this is the one that we want to avoid. We want to avoid the deflationary bust. So the economy just keeps kind of going back and forth between the 3 other quadrants, which are inflationary boom, which I think is probably what we're getting into. Disinflationary boom, which is where we're coming from. Inflation was coming down and we had everything booming. Or finally, what I hope we can avoid, which is a stagflation. But the last one, which is the deflationary bust, will never get there because of part of what I discussed, the amount of excess savings, the wealth effect, the rise of the gig economy, and then the fact that we're running deficits of 7% of GDP at a time of expansion, and that we have a Fed that, starts cutting rate by 50 basis points when the unemployment rate is at an all-time low and the stock market is at an all-time high. So we've effectively made that impossible. And the investment implication that I see from this analysis is that you don't need long-term treasuries in your portfolio. So one thing I forgot to mention is that each of the quadrants is associated with one asset that does well, right? If you have a disinflationary boom, big tech, growth stocks do very well. If you have an inflationary boom, typically it's going to be emerging markets. If you have stagflation, it's going to be gold and commodities. If you have a deflationary bust, it's going to be treasuries. Well, if we don't have deflationary bust, we don't need long-term treasuries. And indeed, for the past 4 years, treasuries have really been the one asset you didn't want to touch with a 10-foot pole.
Now, Keynesian economists would say what you've just described is a victory lap for countercyclical stimulus policy. Government can impose policies that successfully avoid recessions. Yay for government, and yay for government intervention in the economy. And then, of course, the Austrian economists would say the opposite. They would say it's a recipe for disaster because there's no free lunch, and although you can do those things in the short to intermediate term, they always come back to bite you in the end, and you end up with a massive bust as a result of all of that policy eventually backfiring. I think about something like the way the Australian government has been managing their housing boom, and a lot of people said 10, 15 years ago, look at what happened in the U.S. It's about to happen in Australia. Well, does the Australian government get an A+++ for keeping their housing boom going for 15 years longer than anyone thought possible? Or have they created peril for their people because a much bigger housing bust is coming and can't be avoided the way von Mises famously predicted that there was no avoiding the ultimate bust? Those are two opposite views, obviously, from von Mises and Keynes. What's the Vincent Deluard view?
Probably a bit of both, but Keynes come before Mises. And in the US, we can do Keynes for a lot longer than more people can think. I think what you kind of alluded to it, right? I love the Australians. They're great, but you're not going to make money from trading. It's got almost like a moralistic aspect to it. Like, oh, this should not be happening, therefore it won't. This is not the way the world works. Things that should not be happening can keep happening for a long time, whether you like them or not. And yeah, it's possible that at the end, this all ends up with a giant bust. But in the famous word of Keynes, in the long run, we're all dead. And I think in the US, we have this ability to run these kind of policies for much longer than other nations. Australia, I think part of it was, when you talk about real estate for Australia and Canada, you have two things to take into account. One is the amount of Chinese money that they get, and two, the immigration that they get that can really keep these things going. Probably without these two forces, you would have seen indeed the bust of the Canadian and the Australian housing market. In the US, yeah, we issue the world reserve currency. As long as the bond market lets us do it, I think we can very, very easily run a deficit of 7% of GDP. By the way, 7% of GDP is not that bad right now. If you go with my view that true inflation is around 4% and real growth is at 3%, you run a deficit of 7% of GDP and you roll over your existing debt at 3%. You actually deleverage the economy. So I think the Canadian experiment can run for much longer than people can give it credit for, and trying to capitalize on this kind of judgment day. Oh, finally the Australians will be right, and the prices will fall like crazy, and the sinners will atone and will get flogged. Is again, it's a religious way of thinking about markets, not an economic one.
Vincent, the third StoneX intelligence report that you are sharing with our listeners, and again, it's in the Research Roundup email, you'll find the links, folks, is called The 5-Body Problem. Now, this one reads as if it was something you wrote just after the election to kind of put the election in context. But this was actually written before the election. I think you just happened to get the calls right. Tell us what this is about.
Yeah, so it starts from the famous 3-body problem, which is a physics problem, which really tells you how little we understand about the world, that if you have 3 objects that are orbiting, after a while it becomes so chaotic that even with all the computing power in the world, you cannot predict where the 3 objects are going to be, even though the initial position, the velocities are known. So this is kind of maybe a little humbling when we try to predict capital markets, which are the product of the interaction of the action of 9 billion people animated by, religion and maybe personal freedom and ideologies and so forth. So our ability to predict is quite limited. But I was trying to narrow it down, at least on the macro side, to 5 big questions, which I think are the ones that mattered before the election, and to some extent they still matter today. So the first question is, will the US maintain this high level of growth, that 3% plateau that I've been talking about? 2, will the Fed stay behind the ball and maintain its dovish bias? 3, will Chinese stimulus be successful and turn things around? 4, will there be a red sweep at the November election? And 5, will there be an oil shock? And I think between these, if you can answer these 5 questions correctly, you have the macro Rubik's Cube more or less figured out. For what it's worth, I can tell you what my guesses were before the election. So on the high level of growth, this has been my view for several years now. No recession. And yes, this is kind of a new plateau. The only thing that I will add now is that I'm starting to be consensus, and it's starting to bother me quite a bit. I loved it 5 months ago when everybody was looking at the SAM rule and all these, crazy recession theories, or before that when it was about commercial real estate, we had so many imaginary recessions before. It was very easy for me to be in the other camp. Now with the election of Trump, I see the consensus shifting so rapidly towards my camp that I think that bar is moving. Like 6 months ago, all that you needed is not to have a recession and you were ahead of the game. Now I think we need actually accelerating growth for that to be true. So I would still give, yes, I believe strong nominal growth, but I think that's getting more and more priced into the market. Second question was, will the Fed maintain its dovish bias? I don't know what you thought of last week's press conference, but I thought Powell was quite dovish. He kept repeating that, he thinks the policy rate is restrictive and he wants to bring it down to neutral. I believe the policy rate is accommodative. So every time he brings it down to neutral, he actually makes it more and more accommodative. Will Chinese stimulus turn things around? On that, I will turn to our mutual friend, Vincent Deluard. I think he's done the best work on the Chinese economy. And I tend to agree with him that this might be the real deal. I believe there's a chance now that Trump is elected that actually increases the impetus for the Chinese to get their stimulus going, because they know that the trade route is probably not going to work. They're going to be facing a very aggressive, more nationalistic U.S. administration. So they really need to get their economy growing again. The red sweep, well, we already had it, right? We had the Republicans winning. I think now it's confirmed that the Congress as well. So that will have the answer. And then will there be an oil shock? So far, no. Oil has actually sold off on the news of the election. We're kind of at the bottom of that 65 to 75 trading range. So if I put everything together, that's still a pretty favorable environment for stocks. And I don't like to say that because I realize that stocks are insanely expensive. They're rallying 3% every day. I calculated the Sharpe ratio of the S&P 500 for the past year is around 3. So it doesn't feel good to be long stock. But if you just look at the macro stuff, you have to say that things are unfolding in a way that is bullish for stocks.
Vincent, I agree with you that our mutual friend Louis Gave does, I can't pronounce it in French as well as you can, but Louis does terrific work on China. Let's get your perspective, though, on China and maybe broaden that to other international assets. Where is the U.S. dollar headed? I'm sure you're familiar with kind of the Luke Gromen versus Brent Johnson debate about how this whole dollar situation plays out. Does it strengthen or does it weaken? How do you see that going? How do you see China playing into it? Is the China recovery finally going to be realized, et cetera?
Yes. I think I'm more in the Louis Vincent, Luke Gromen camp over the long term, but I could certainly see the Brent Johnson scenario playing out in the short term, which is kind of what we've had since the election, with the dollar index going straight up. On China, there seems to be a big disappointment moment right now. When the stimulus was announced in early September, we saw the market rally about 50%. Now we've retraced a bit more than half of these gains. And the consensus seems to be that, it's just a fade. They tried it many times before, and the kind of policy they announced are not strong enough for the problem that they face. I think that perspective is biased by a lack of understanding of how China works. I think there is this view that whatever she says happens right away, that China is this kind of dictatorship, which to some extent it is, but it's a formal dictatorship. It's one that you still have, even in China, there is a political cycle. If you want to pass policy, you need to get it through the Congress. And that meeting happens in late December. And yes, maybe you flesh out the policy goals at the Politburo meeting, but it takes a couple months to get it announced. So the fact that they have not announced anything substantial since September doesn't mean that it's not going to happen. It just means that they're following their own calendar. There's also probably a strategic reason for them not to announce something too prematurely is the poker game that they're playing with the U.S. They want to see what Trump's going to do on the tariffs, and they want to target the response based on what Trump does. So again, that argues probably more for something that's postponed rather than non-existent. And then another element that I think people miss is the extent to which China is decentralized. It's not just Beijing decided. I mean, most of government spending happens at the local government level, which is why if you look at the latest initiative, which was basically a debt swap for local governments, yeah, the amount was a bit disappointing, but the direction is right. If we want to stimulate the economy, you need to deleverage local government and give them the means to stimulate the economy. So there's nothing in what I see that suggests that the Chinese stimulus is not going to happen. This could be if you follow the 2008 US analog, we had the stimulus with TARP, with the ban on short sale, all the big policy measures were undertaken by October, November, December. And yet the market did not bottom until I think March 9 or March 3. So it took about 5 months between the moment when the government said, okay, we're throwing the kitchen sink at the problem and seeing the actual bottom of the stock market. We may see the same thing in China where you actually see you kind of bottom out now and you see the final bottom. Maybe I would guess it would be around the inauguration of Donald Trump. When you see the tariffs, and then this is when, everybody's completely given up on China. Oh, the place is uninvestable, the tariffs, blah, blah, blah. This could be the time when you actually see this kind of secular bottom for Chinese equities. So I would advise for some patience there. And then the follow-on to that is if we see a successful Chinese stimulus, that's obviously very good news for South Korea, Indonesia, Malaysia, a lot of Latin America, a lot of the Middle East as well. So you could see this successful Chinese stimulus kind of drag along international assets, which have been one of the long-suffering trades, right? For 15 years now, you've seen the U.S. outperform non-U.S. stocks by 10% a year. I suspect we're getting close to the end of that period, partly because of that Chinese stimulus, partly because of the end of the Japanese carry trade, and partly because of the Fed, who's, kind of done with rate hikes and is telling us that they actually want to be behind the curve on inflation.
Something I've started to look at in the much longer time frame with regard to China is nuclear energy adoption. In the West, we finally figured out that nuclear energy always has been the safest, cleanest, greenest way to make energy. But boy, in democracy, you have to pay for the wonderful value of democracy by taking the time it takes to reach agreement and consensus before you invest in something as controversial as nuclear energy. China has the benefit of, hey, we don't need to get the approval of anybody. We just do what we want. And China is at least 10 or 15 years ahead of the West on all things nuclear. On the conventional side, China has more planned and proposed reactors than the entire U.S. fleet. On the advanced nuclear side, China has built the only thorium-fueled molten salt reactor since the one that was built at the Oak Ridge National Laboratory in the 1960s. On all of the other advanced nuclear technologies, whether it's high-temperature gas-cooled reactors for energy transition and hydrogen production and so forth, they are doing everything now that we're just starting to have a democratic debate about. What could this mean long-term in terms of Chinese economic and eventually military dominance?
I think you're spot on. I mean, the work you've done on these issues is remarkable. And I think not only true on a market sense, but essential on the policy level, because these are the questions that will matter in the next 20, 30 years. What decision have we made today to prepare for that? And indeed, nuclear is one of them. It could be that nuclear is at the same moment where, rockets were with Elon. Before we had Elon and SpaceX, sending rockets up, cost a lot of money, had to be run by the government, and there was not much in terms of improvement. And that's kind of the Western approach to nuclear energy, right? We're going to commission one giant plant, And of course, it's going to cost a lot of money because everything you build once, you have to start from scratch every time. But what the Chinese seem to be doing is kind of what SpaceX is doing to rockets. Like, listen, instead of like building individual rockets and spending so much money every time, maybe we can do it a bit smaller, and maybe we can actually reuse that, and as a result, shrink the producing cost by a factor of 80, 90%. And I think that's what's happening in China. So at the base, you have the physical advantage of nuclear energy, which is higher energy density than any other form. But then if you added to it the economies of scale of being able to replicate the same design and do it on a smaller scale, you do have what I think is the solution to the biggest economic problem, which is how do you generate cheap, reliable, consistent power with which to power your economy.
Well, Vincent, I can't thank you enough for a terrific interview. But before I let you go, please tell our listeners a little bit more about what you do at StoneX. I'm sure they're going to enjoy these 3 courtesy reports, which again are linked in the Research Roundup email. For people who want to get those more frequently, do you have to be an institutional investor? What do you do? How do you sign up?
So if you go to my Twitter handle, at Vincent, Vincent, Deluard, Deluard, there's a pin tweet. Under that pin tweet, there is a link to register for a sign up on my research. It's free. You get a 2-month trial. You can always DM me, and we can maybe consider an extension. I try to answer as many conversations as I can on Twitter because I've learned a lot from Twitter. I met very smart people there. So that's the public facing side. And then if you're an institution, the easiest thing you can do is be a client of StoneX. I'm sure a lot of you listeners already are. We're very big on futures, securities, commodities as well. So if you already have a StoneX account, just ask your rep, hey, I would like to get Vincent stuff, or send me an email directly, vincent.deluard@stonex.com. And I'll make sure to share my latest reports, presentation, webinars. And then if none of these things work for you, podcast. I think this is really been a fantastic way to have conversation with very smart people. And I keep doing it. And every time I do it, I keep learning things. And I hope to do it again soon.
Patrick Ceresna and I will be back as MacroVoices continues right here at MacroVoices.com.
Now, back to your hosts, Eric Townsend and Patrick Ceresna.
Eric, great to have Vincent back on the show. Before we dive into the chart deck, you said you wanted to share some perspectives on the news flow from the Trump team since the election. What's on your mind?
Well, first of all, I strongly recommend Pippa Malmgren's interview from last week for anyone who missed it. I agree with Pippa's view that who just won the election was the populist movement over the establishment. I really don't think this was about Trump and Harris. I think it was about the American people saying enough to the establishment and voting in favor of the populist movement, which Mr. Trump is still heading. In his first term, Trump was obviously in way over his head, allowing donors to choose his cabinet for him, resulting in Trump being surrounded by neocons who undermined his campaign agenda rather than advancing it. He had 4 years to think about his mistakes, figure out that he had the wrong team, and come back prepared. Okay, so the question is, prepared for what? What was he planning to do if reelected? Well, we just found out in the last week. In my opinion, President-elect Trump is not selecting a cabinet here. He's selecting generals to go to all-out war with the establishment, so-called deep state. Elon Musk and Vivek Ramaswamy have been brutally clear in their numerous interviews that they've done in the last week that their intention is to literally try and fire more than half of all government employees, eliminating entire departments and agencies, and intentionally taking actions designed to provoke tens of thousands of government employees to quit in disgust over their policies. Trump then announced Tulsi Gabbard as Director of National Intelligence. Now, frankly, the only thing I can think of that would have been more effective if his goal was to directly and intentionally provoke a power battle between the intelligence community and the new Trump administration would be if he had perhaps pledged to pardon Edward Snowden and make him the DNI. The message to me is crystal clear. Trump's intention is to take the gloves off and go to war with the so-called deep state agencies. The drain the swamp and expose what's living beneath the surface mantra of Trump's first term in office has apparently been replaced with a new agenda to vaporize the swamp and kill everything in it, with relatively little concern for the collateral damage that occurs along the way. The last time any president came remotely close to waging war with the intelligence community was when President Kennedy threatened to, quote, smash the CIA into 1,000 pieces. That didn't end very well for him. Trump has signaled in his first week as president-elect that his intentions are to be far more aggressive and provocative in engaging the deep state than Kennedy ever was. This means that the establishment wings of both parties are likely to turn against Trump. Vivek's comments about firing every government employee with a Social Security number ending in an odd number are certain to provoke immense animosity with most government employees. So the bottom line, as I see it, is that to whatever degree there was resistance to Trump taking office from the establishment wings of both parties and from the devout Democrats and Antifa people and so forth that didn't like him, whatever it was that they were going to resist with, I think it just quadrupled based on the announcements that have been made in the last week. There is an existential threat to senior entrenched members of the intelligence community that have been in their jobs for decades. And that means that for Trump's enemies, absolutely anything is now on the table. Articles of impeachment could come before Congress on January 21st, one day after he takes office. The odds of the Democrats refusing to certify the election results probably just increased dramatically in the last week as they got a sense of what he's intending. All of the lawfare options, including the 25th Amendment and somehow trying to claim that he was not eligible to serve, which probably for the reasons Pippa Malmgren described in last week's interview might have come off the table because, boy, he won by such a landslide. Pippa said maybe they were going to fight this, but after that landslide, it's kind of hard to fight it. Well, they just got a whole bunch of incentive to fight it anyway. At least that's the way I'm reading the tea leaves here. So while we had a red sweep and the Republicans are going to control both chambers of Congress, that doesn't mean that MAGA Republicans are going to be in charge of all that. The Democrats are going to try to cut a deal with establishment Republicans who are threatened as much as they are by Trump and say, look, we got to work together to get rid of this guy. Bottom line, what I see in store for markets is a whole lot more uncertainty and volatility. In terms of trades, I'm starting to think about strategies to exploit underpriced volatility. Straddles, long VIX trades, that sort of thing.
It's very hard to dispute that he's putting together a team to shake up the establishment. It'll be very interesting to see in the next few months to see how the establishment pushes back. Now let's get to that chart deck. Listeners, you're going to find the download link for the Postgame chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Vincent's picture saying, looking for the downloads. Now, Eric, let's cover crude oil.
EIA inventory was delayed by the U.S. Veterans Day holiday this week, so we don't have any statistics for you. We got back down to the low end of the trading range to a 66 handle in the last couple of days, back up to mid-68 handle as I'm recording here early on Thursday morning. Given how boldly President-elect Trump's other policy moves have been, I don't rule out an extreme move or say some kind of deal with Mohammed bin Salman to manage prices lower, at least initially after taking office in order to kind of prove himself to the American people as doing something Biden couldn't do. So I could see it going that way. I could also see a big escalation of geopolitical risk taking it the other way. Bottom line, I'm flat here. I don't see any attractive directional trades unless you have inside information that I don't have.
Well, Eric, I'm just going to give a simple technical assessment. The price action remains distributive. The primary downtrend is down. The descending trend lines are intact. Below all moving averages, all rallies fail. It's incredibly distributive and bearish price action. Now, we are trading at a key support line. Throughout September and October, the lows were established at this price level. And so we have a primary downtrend trading along a key support line. And those lows also were the lows that were established back in May of last year, including November and December of last year. So we're at a key price level where a lot of lows have come in. So if this level and the support line gives out, which is entirely possible, that would open the window for a decline down into the low 60s, down to even 62 or 60 on the downside. Now, I'm trying to give the bulls the benefit of the doubt that the support line will hold. But again, the primary trends are down. So if that support line gives out, another 10% decline in crude oil is entirely on the table. Now, let's move on to equities. What's your thoughts here?
The initial reaction to the election result was clearly positive, but now the rally has paused as markets absorb the news of just how extreme Trump's cabinet picks are going to be and what their stated intentions are about what they plan to do when they take office. So I really don't know what's going to come next here, but I think we need to watch carefully at the continuing news flow out of Team Trump and understand where they're planning to take this administration, and are they really intending to be as brutal as Elon and Vivek Ramaswamy seem to be talking.
Well, Eric, over the last month or so, we were so close to the 6,000 level. And it was ultimately the election results that added the clarity and the tailwind for the market to make this burst to that round number of 6,000. There are measured moves that are up to 6,200 plus on the upside. So there is still room for this market to go higher here. The momentum is clearly in the bulls' favor, and there is zero sign of distribution. So one has to approach this with the assumption that the bulls are in control of this trend, and the momentum is in their favor, and follow through and flows are likely to support that, at least for the short term. My view is that at this stage, this market can easily continue in these prevailing trends of things that have been working, will continue to work right up until the U.S. Thanksgiving. At some point, all the flows and rotation that was happening to drive this will have fully played out, and the market will reach an exhaustion point. But there is zero sign that we've reached that level. So we have to respect these prevailing trends. The patterns of higher highs, higher lows, trend lines above all moving averages is still very much in play. And so we'll see where the exhaustion points come. But right now, I have to give the bulls the benefit of the doubt, and we're going to see how far they can take this. Let's move on to the dollar index. So what are your thoughts here, Eric?
Well, the big news I was going to report on this week's podcast was, oh boy, the Dixie took out 106 to the upside. Can we get to 107 by next week? Well, just in the last few hours before I went to record, we're at 106.925 right now on the December contract. I'm going to call that close enough to call it a test of 107. Are we going to break through 107? Are we headed all the way back to 116, which was the prior cycle high? I don't know, but this is going to get interesting. Let's see where this market takes us.
The momentum doesn't quit. We're trading back to the 2023 highs, what's now been a 2-year trade range, and the momentum isn't even slowing. Now, we are literally trading at the time of recording here at the 107 level, which is essentially the highs of this range. I mean, with this kind of momentum, if the bulls can somehow miraculously break it out of this trade range, that opens a huge upside window. My initial thinking always is that these resistance levels should at least temporarily stall price action and act as some form of resistance. But the momentum has been so strong going into this. It'll be very interesting to see whether the bulls can break this out. On page 5, I have the Euro USD, and I put it on a weekly chart so we can really see this on the reciprocal of that dollar index. And you can see that breakdown in the euro is so distinct. We're right back down to the 105 level again, a 2-year low, and this is going to be a very important line in the sand. Either the euro can muster up a bounce off this level, or it will be the driver of a big US dollar breakout. This is clearly the currency cross, and therefore this is the one to watch. And this 105 level is just critical on this. And again, like I was saying to the dollar, this is a level where you should technically anticipate a bounce. It's so oversold on the euro, coming right into a very key support line. At least a reaction or a pause should happen here. And if it doesn't, it just will tell you how strong that momentum is. And certainly that could create some incredibly volatile events. Now let's move on to gold, where there's been that extraordinary move. And I'd love to get your thoughts on this.
There's no doubt in my mind that what's happening here is a rotation out of gold and into Bitcoin. And Bitcoin, for anyone who missed it, hit new all-time highs this week as gold dropped like a rock. I see the view that Vincent Deluard expressed in the feature interview, that Trump is just playing politics and paying lip service to what the crypto crowd wants to hear, as a distinct possibility. That might be the explanation here. It might be just telling them what they want to hear and then back to business as usual. But the crypto community's pipe dream has always been to create a new money system that would compete with and then eventually displace government-issued money, democratizing money itself so that no government can control it. Now, the central thesis of my 2018 book, Beyond Blockchain, was that while that sounded great to libertarians, the reality of the situation was that major governments, that's the people with all the guns and the handcuffs, would never allow privately coined money, whether it be crypto or otherwise, to take away their monopoly on the issuance of money and the ability to control its supply through government-controlled monetary policy. That's where the most entrenched, powerful people that exist in the world gain their power, is from the ability to do things like control the money supply through monetary policy. But if ever there was a government that just might allow or even encourage the replacement of government-issued money with decentralized digital currency that no government has direct control over, well, it might be a government where Elon Musk and Vivek Ramaswamy were apparently just given the green light to fire more than half of the current government employees. Now remember, Elon is a big crypto fan, and one of his favorite cryptocurrencies seems to be Dogecoin. Is it a coincidence that the new Department of Government Efficiency has the same name as Elon's favorite cryptocurrency? Now, to be clear, I don't think that President Trump has any idea what the implications are of encouraging widespread cryptocurrency adoption as a sanctioned alternative to government-issued money. One of President Trump's other objectives that he's been very emphatic about is he says that we absolutely need to safeguard the U.S. dollar's role as the global reserve currency. I don't think President Trump understands that those two goals are diametrically opposed. But the people he's putting in on his cabinet seem like the kind of people who might just favor such a move. As I said earlier, I don't think President Trump's bold new agenda of firing half the government and going to all-out war with the establishment wings of both parties is going to see anything but the strongest possible resistance and opposition from most of the government. And I don't rule out the possibility that Mr. Trump will never be sworn in for a second term, despite his landslide victory in the election. The stakes have never been higher for the entrenched powers in Washington, so their response will be equally forceful and dramatic. Coming back to gold, if we saw a government-sanctioned popularization of Bitcoin, it could be very, very bearish for gold, at least initially. Now, central banks around the world would continue to favor gold rather than Bitcoin, but the price trends in gold and Bitcoin since the election speak for themselves. And if the Bitcoin momentum continues beyond $100,000, that could easily cause the last gold bug standing to eat their losses and chase the Bitcoin train instead. Moving on to the technicals in gold. Just before the European markets opened on Thursday morning, we were sitting right on the 100-day moving average at 2560. That's 2560, which was also the 21-week moving average. And to my eye, it's kind of a make or break line, an important one. 2600 should have been trend line support, and that should have been good at least for a significant bounce, but the market just went through it like it was melted butter. So, and that's a trend line that's been in place since last February. We didn't even get a bounce there. So if you're feeling lucky, right here as we're dipping now after Europe opened, we dipped all the way down to just over 2540. I think the number is 2542 is the lowest print I see on my screen as I'm recording about an hour and a half after the European Open, 5:30 on Thursday morning. It looks like we're down at 25. 542 is the low. If you're feeling lucky, that was your dip below the 100-day. We'll close above the 100-day by the time Thursday is over because, boy, that's such a clear line in the sand. It's got to hold. Well, if it doesn't hold, then there's probably some Fibonacci support around 2,500 to 2,520. If 2,500 even doesn't hold, I think it's a fast ride down to 2,400 at the 200-day moving average. And if that doesn't hold, anything's possible after that. The reason I'm going out of my way to intentionally mention these targets that are hundreds of dollars below the market is I think that if there is a government change of attitude where all of a sudden cryptocurrency is welcome and, the Trump administration is issuing executive orders saying, we're going to be nice to the crypto community and we're going to have a strategic Bitcoin reserve and so forth. If they really followed through on those things, I think it could be really, really damaging to gold. Bottom line, there's more uncertainty in this market than anything else. I certainly regret not following my own instinct. I said here on MacroVoices 2 weeks before the election, I don't understand why everybody is so bullish on gold if Trump wins. I think you could make the opposite argument more persuasively. I said that, but I didn't hedge my position nearly as much as I should have, and it's been a painful ride down. In any case, I'll be watching what happens here at the 100-day moving average. As I'm recording, we're still below it. A close above before the end of the day on Thursday would be a refreshing symbol that maybe we're going to put a bottom in here. If it keeps going south from here, I think we really need to be careful in terms of what comes next.
Eric, I'm just trying to keep this far more simple. You look back to the pre-election gold price, the sentiment was so bullish. Everybody was in clear consensus. Gold could do no wrong and only had upside. It was a lopsided trade that was due for some sort of a correction to shake out weak hands and over-leveraged traders. So with this short-term high, we've now 50% retraced the rally since the summer. And giving back half of the gains is actually a typical retracement. But now we are actually at a very key line in the sand. The August-September consolidation that happened in this 2,500 area that was at the time a key high is now going to act as potentially support. The key Fibonacci retracement level is right at this 2,500 level. And so this is a very logical place for the short-term downtrend to at least pause and offer a reaction, something that could easily bounce $100+ an ounce off of these support lines. Will it? And that's the big question. I mean, so, you can see the dollars at these extreme levels. So many of these markets are at these extreme points. And it feels very much like either all of them are going to react or none of them are. And if none of them are, if these prevailing trends keep accelerating, at some point it's going to become a market disruptor. And so right now we're at a critical support. Let's see if it holds in this next $50. Now, moving on, Eric, I wanted to just touch on page 7 on the copper price. Now, copper was trading along its 50-day moving average, right along a retracement zone, a logical place that if there was going to be a bull continuation pattern, it would have acted like a key support around that 4.25 area. And this week, that the feet just got cut out from underneath the copper bulls. And when that key support level was given out, it was like it dropped straight down right to the August lows. This is now re-engaging a prevailing downtrend that was in place from May till the summer. Now we are approaching the August low, which often can offer a support. But if we see that this the bulls don't rebound this in any meaningful way, we may find ourselves right back into the 2023-2024 trade ranges, which were in that kind of $3.75 to $4 area. And so there could be still further downside in going into the tail end of this year. Now, Eric, let's move on to uranium. What are your thoughts here?
A huge amount of bullish news flow came out in the sector this week. 6 more signatory countries signed on to the Triple Nuclear Pledge. Now, this started at the COP28 conference in Dubai last year, where 22 nations initially signed on to triple nuclear energy globally by 2050. 6 more countries signed on at the COP29 conference that was just held this week. So I see this as really important because we're seeing more and more government consensus around nuclear being the solution to climate change, which has been a lot of government's obsession. What they need to figure out next, and I'm doing everything I can to try to get audiences with them, is to recognize that government absolutely needs to get involved in clearing the way for the adoption of advanced nuclear technologies. We've got to ditch these light water reactor antiques, which is still the technology everybody's using because of government bureaucracy being unready to regulate much newer and better designs. And when I'm talking about much newer, I'm saying we got to ditch the 1950s nuclear technology in favor of much, much better stuff like late 1960s technology. These problems in nuclear engineering were solved a long time ago. We never adopted them because the governments around the world have been standing in the way of progress. It's time to recognize that the solution to climate change and energy transition is to fast track the adoption of advanced nuclear technologies. I think that this continued support of the Triple Nuclear Pledge and more countries signing on is paving the way for some countries around the world to finally stand up to the United States and say, Section 123 has to go. It's time to get serious about advancing nuclear technology and not staying stuck on 1950s technology. Sorry for the editorial there, folks, but I really think this is important to the future of humanity. Next news item, NVIDIA, that's the AI guys. They've made some kind of deal with the Diablo Canyon nuclear facility, which was scheduled for shutdown. They're resurrecting it. Now, nuclear facilities have to be air-gapped for security reasons to protect them from terrorism and so forth. NVIDIA wants to put their AI inside the nuclear power plant, so it's not air-gapped. They won't be on the internet, but they will be AI operating inside an old-school 1950s technology nuclear plant. I don't quite understand what the angle is there, but certainly big nuclear announcements are coming out every day now. Tripling nuclear is going to require a 10x on enrichment capacity, according to Orano, one of the biggest enriching and reprocessing operators, a French company. We don't have it. Most of the enrichment capability is in Russia and Kazakhstan. There's a huge need to build it here, and there's a huge opportunity to build more. The state of Kentucky just announced a new development authority to plan how Kentucky is going to adopt nuclear. Yet despite all of this massively bullish news flow, F3 Uranium, which is a terrific exploration play, great stock, and I don't know of any significant adverse news to explain it, just retested the September 6th lows at I don't know if it got 20 even, but it was 20.5 cents. I bought a bunch more this morning at 21 cents. That's a fantastic deal. It's the only stock I see that's really retraced that September 6th low, and it's a strong buy here. So why are we seeing these bargains in uranium miners, especially an exploration play, which is a more speculative play about the future as opposed to current cash flow, when there's so much news telling us that uranium demand will be increasing in coming years? Fundamentals couldn't be stronger, and we're seeing buying opportunities anyway. Why are we seeing them? Because there seems to be a buyer's strike in the physical market. The utilities are holding out, delaying their purchases or something, hoping they're going to get a big trend reversal. I don't think they're going to. The fundamentals are too strong. I think that there's going to be a holdout and wait tug of war, and I think the utilities are going to lose and the uranium prices will eventually move sharply higher. Right now, though, there seems to be a buyer's strike, and in my opinion, that's what's holding back a big move higher in uranium-related issues. We are seeing a few of them really take off. Things like NuScale, ticker SMR, Boy, after going public around $10, they were down to $2. They're almost 26 this morning. So some of those nuclear startups are really taking off. Uranium will catch up as soon as the spot market catches up. And I think that's just a matter of resolving this buyer strike.
Well, the story in the post-election period is about the things that are working versus the things that are left behind and or just treading water. And initially, I thought that uranium might get some tailwind in that post-election period, but that's clearly not been the case. At this stage, this is a market that has been relatively inactive and ignored on the short term. Now, obviously, uranium equities have done much better, but when we're talking about spot prices, uranium and the uranium trust and other things like this, it really hasn't gotten any flows. And so it'll be really interesting to see whether this support line holds. It's a very logical area for uranium, the U308, to kind of settle at these prices. But bottom line, there isn't any prevailing trends here. And I would assume, at least on the short term, that this will continue as most of the money flow going around is just chasing what has been working. Finally, Eric, I just wanted to touch on the Bitcoin chart. I don't have too much technically to say beyond the fact that it's been an extraordinary breakout. I mean, we had a huge bull run between 2023 and the first quarter of 2024. It went from like 25, 70 plus thousand. And then we went through what was basically a 6-month dead zone trade range. And clearly, this Republican administration has woken this up. Now, if we look at the rules of symmetry and use that as projecting tools, this does measure all the way to 100,000, and that's been a huge psychological level that a lot of the crypto community has been targeting. Now, this move to 90 plus thousand has happened a little too quickly, and so there's always room for things to pause and consolidate, but you have to give the bulls the benefit of the doubt that even if we did see a $2 to $5 or even $10,000 dip, it will be bought on dip, and the primary trend will be up. Will we get that deep of a dip, like a test back toward a 50-day moving average as it's approaching higher? At some point, the rally will get checked. But at this stage, some new life has been put into this, and assuming that this is already over is too premature. At this stage, measured moves are up to 100,000, and let's see whether the bulls can pull it off.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com. Patrick, tell them what they can expect to find in this week's Research Roundup.
In this week's Research Roundup, you're going to find the transcript as well as the articles that Vincent shared during the interview. You'll also find the chart book that we discussed here in the postgame, including a link to a number of articles that we found interesting. So you're going to find this and so much more in this week's Research Roundup. That does it for this week's episode. We appreciate all the feedback and support we get from our listeners, and we're always looking for suggestions on how we can make the program even better. Now, for those of our listeners that write or blog about the markets, we'd like to share that content with our listeners. Send us an email at researchroundup@macrovoices.com, and we will consider it for our weekly distributions. If you have not already, follow our main account on X at MacroVoices for all the most recent updates and releases. You can also follow Eric on X at Eric S. Townsend. That's Eric spelled with a K. And follow me at Patrick Ceresna. On behalf of Eric Townsend and myself, thank you for listening, and we'll see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.